Hi there, Jan from Berkshire Hathaway here, and I wanted to bring you some new information about the housing market. If you're anything like me, anytime you log onto social media, onto the news, whether it's TV or internet, there are all kinds of scary headlines predicting all kinds of doom and gloom related to the housing market and the sky falling and everything coming to crash down. So, what are the real facts that we need to look at so we can get some actual perspective on what is going on with the housing market? Well, what is happening is we are moving into a more normal housing market. What we experienced the last 2 years in the post COVID recovery were not normal at all. Mortgage rates are still historically low. And as you can see from this graph, which shows mortgage rates from 2016, even something in the fives is not unusual. We had a period in 2018 where mortgage rates were in the fives. So we need to be a little bit more realistic on what we can expect. Mortgage rates are a tool that the economy has to stimulate the economy. And they have done that job by lowering rates. And now it is time for them to go back up. That is going to bring us into a more normal market. And repeat this to yourself: normal is good. Just to give you an example of what the Fed is trying to achieve with interest rates, take a look at this graph. So this shows the percent increase, not the actual dollar value, but the percent increase year over year of property values. So as you can see, that first bump on the left is post Great Recession recovery. So of course, as we're coming out of a recession, that resulted in really, really low home values. Of course, as it begins to recover, home values are going to increase year over year. Then, sort of end of 2014, we settled into a more normal market that, went up and down a little steadily year after year. 2019, we saw a little settling in of home values. And then this giant bump to the right is the post-COVID recovery. That is not normal. So normal is 3 to 5% increases year over year. 20 to, some people are saying nationally, even areas that increased 37% in value year over year. That is not normal. And that is what the Fed is aiming to try to change by raising interest rates, hoping that crazy appreciation and inflation of real estate values is going to come down to normal. So if this year you had real estate values increasing at a normal 3 to 5% interest rate, 3 to 5% rate, wouldn't that be a good thing? Now, let's talk recession, which is on everybody's mind because, of course, our memories for some of us are very strong. And when we think recession, we think the most recent recession that we've had, which was 2008's global financial crisis. What we don't realize is that we have had multiple recessions since World War II, and that is the only one that resulted in a significant reduction in home values because it was caused by the real estate industry. The other recessions that we've had along the way, most of which resulted in an increase in home values. So recession does not automatically mean a reduction in home values. And considering that we still have historically low inventory shortage, the likelihood that it is going to make a significant difference in real estate values is still very small. In the 2008 crisis, we had an incredible supply of homes on the market due to all the foreclosures and people walking away from them. So of course, high supply equals low prices. So I want you to take a look at that graph. That really gives you an idea of home values, and the only significant dip in values was the 2008 financial crisis, even though, keep in mind, we have had multiple recessions since World War II. It is also incredibly hard still to get a mortgage, as you can see from this graph and the number of mortgages that are given in any given year with credit scores below 620. So if a foreclosure did occur, even though they are at historic lows, then the property would be listed at market rate because there's not an oversupply of properties, and it would get sold for market rate, doing very little to affect the average home values in the area. Now, let's talk a little bit more about our local Southeast Michigan market. So, in any given time, months of inventory is going to dictate whether you have a buyer's market or a seller's market. Now, months of inventory refers to this. If I was to take a snapshot of every single house that was currently on the market and no new houses came on the market, how long would it take for everything that is on the market today to sell? And that is what we mean when we say months of inventory. So if everything's sold in 2 months, that means we have 2 months of inventory. So a normal market in balance is about 5 to 7 months of inventory. Higher than 7 months, we're getting into a buyer's market. Lower than 5 months, we're getting into a seller's market. Now, the last couple years, we have had an average of 2 to 3 months of inventory, which is why we have this really insane appreciation that we've had. And in some submarkets, the amount of inventory was as low as 2 to 3 weeks, which is why we have situations with 20 to 30 offers, with tens of hundreds of thousands in some markets, people paying above asking price, waiving inspections, waiving appraisals, all of that. So we are heading more towards normal as interest rates increase, but we are still not in balance. So currently, Southeast Michigan average, my entire MLS system, which is actually bigger than Southeast Michigan, bigger than the Tri-County area, we have an average of 1.4 months of inventory as of today, which is half of what we had at the beginning of 2019, which you can see from this graph. More things that we can expect from a normal market are longer days on market and price reductions. Price reductions do not mean that property values are going down. What it means in a shifting market usually is that people are pricing their properties initially too high because they are expecting to price them like they're going to have a 20% increase in value over their neighbor's house that sold last week. And as we can see, those increases are settling into more normal. So if somebody is overpricing their property and the market is changing, a price reduction is natural. It does not mean that property values are dropping. It just means that we are getting our property list prices more in line with normal. And days on market time is something that goes hand in hand with that. Properties are going to stay on the market longer because there are fewer buyers out there and they are taking their time figuring out what they want. So from this graph, which is for our local MLS market, for all of our MLS, Southeast Michigan and beyond, the average days on market today is 26. Compare that to the beginning of 2019, where it was about double that. So longer days on market, absolutely normal, nothing to be concerned with, no reason to panic. So thanks so much for watching. If you have any questions, you want to talk about the real estate market, you want to talk about interest rates, I am here for you. Give me a call, shoot me a text, or email me. Have a great day.